How could a low-risk, safe investment be the catalyst for the next financial crisis? One like any we've seen before. Unless you're Joe Biden, you've realized that the US is entering a recession. And it's currently the people at the bottom being squeezed with higher costs, higher prices on everything from food and gas that are going to be absolutely devastated, widening the gap between the rich and the poor, which could be one of the worst financial crises in the last century. It's no surprise that inflation being 0.6 month over month is shocking, especially this late into 2022. Inflation obviously being more clinging than anyone expected. Rising rents, rising healthcare costs, rising food costs at some of their highest points in over 20 years, forcing the Fed to increase interest rates and the stock market obviously reacting to these things. But there's something lurking in the background that could be the catalyst for the next financial crisis, and nobody sees it coming. At a moment like this, where you see the S&P 500 down nearly 20%, most staple stocks down well over 50%, what's wrong with an investor going out and buying a 2-year Treasury bond, which yields nearly 4%, no risk if held till maturity, reinvesting interest into higher coupons, a very defensive and risk-off position. But this is exactly what the Fed wants. They want risk-off money out of the system, slowing down the economy and essentially lowering inflation. But they also want to create liquidity in the bond market, because if they don't, the very risk-off positions being created could collapse the entire stock market and the economy with it, unlike we've ever seen before. Right, so you're saying, Tattooed Man, the bond market's boring. Why are you telling us about the bond market? How is the bond market setting up the perfect storm for the next financial catastrophe? And I'm going to get into it right now, all right? What a lot of people don't realize is the bond market is much bigger than the stock market. In fact, the bond market has a much higher market capitalization than that of the stock market. As of December 2019, the market capitalization for the worldwide bond markets has been valued at approximately $100 trillion, whereas the market capitalization for the worldwide stock market is valued at approximately $70 trillion. And the bond market is extremely important in the macroeconomic scheme of things. And why is any of this important? It's because who holds the largest amount of bonds and treasuries out there? I'm going to give you a hint. It's not banks, it's not foreign holders, it's not whales, it's not mutual funds, it's our buddy the Fed. The Fed currently holds outright securities of over $8.5 trillion. And the Fed is kicking its balance sheet runoff into high gear. The Fed is set to taper off at $95 billion a month. Now, how could the normally risk-free Treasury market become ground zero for another financial crisis? Well, Treasuries play a critical role in the international financial system, with their yields forming a benchmark for trillions of dollars in loans, mortgages, credit cards, student loans, borrowing money for starting businesses, securing an auto loan. All these things go up. Businesses also use Treasury bonds to create capital. And as the Fed prepares to kick its balance sheet runoff into high gear, the thinning Treasury market liquidity could create a perfect storm. Waning liquidity has been an issue since before the Fed started allowing its massive $9 trillion balance sheet to shrink in June. But this month, the pace of its unwind will accelerate to $95 billion a month, an unprecedented pace. Market participants who otherwise might help to compensate for a less active Fed buying these bonds are at or near capacity in terms of their Treasury holdings. So let's break this down. Now, what happens if you have a Fed that's unloading $95 billion worth of Treasury bonds a month and nobody there to buy them? Yields are going to go nuts. Yields have to go up to make bonds more attractive to retail buyers. And when bond yields rise, stocks go down, equities go down. It's an inverse correlation with bonds. And with any market, if there's a lot of sellers and no buyers, stock prices go down. This is Barney stuff, right? So the imbalance of buyers and the Fed selling at historical rates could set up an even further market collapse than we have right now. So let's look at the non-Fed buyers that are near capacity. Now, what we're taking into consideration is the blue graph candles right here, right? Because that's 2022 quarter one. Banks are already at their historic high of Treasury bond holdings. Foreign holders are nearing it. There is a decent gap between MMFs. Mutual funds are damn near at their historical highs, and pension and insurance funds are at their historical highs. This gap right here is not going to be able to sustain a Fed that's tapering $95 billion a month. So as the Fed begins to dump these month after month, yields are going to go through the roof, and it's going to send the stock market into an absolute free fall. Now, as you see here, liquidity is pretty bad, all right? But Treasury market liquidity has been thinning for some time now, with a host of factors playing a role, even while the Fed was still scooping up billions of dollars of government debt per month, which was something it only stopped in March. Since then, bond traders have noticed unusually wild swings in what is typically a more risk-adverse market. So there you have it, guys. The thinning liquidity in the bond market could be the catalyst for the next stock market collapse. I wasn't really sold on inflation being the main factor, but as the Fed continues with the financial tightening and the quantitative easing of their balance sheet, we could see the absolute bubble pop of the Treasury market. And if that happens, the S&P 500 is in for a world of pain. If you're interested in learning one of the most profitable stock market strategies to trade out there, click this video right here. If you want to learn what it takes to become a day trader, the qualifications of a day trader, click this link right here.